Hello and welcome back, everyone, to the Planning Perspectives podcast. I'm one of your two hosts today, Jamie Hopkins, joined by my co-host, Kate Duffy. Kate, great to see you.
Great to be here, Jamie.
So super excited to have back on the show the head of investment strategy here at Bryn Mawr Trust Advisors, Andrew Davis. Andrew, super excited to have you back and get into the conversation here today.
Yeah, me too. Thanks for having me back.
Yes, so today we're going to dive into our 2026 mid-year economic and market outlook. What is happening in the first half of the year, what we see going forward for the back half of the year, and what it means for clients. So there's a lot to unpack today, so let's just jump right in.
Sounds great.
Yeah, so I think heading into 2026, the mandate for the economy and Fed and everything was pretty clear, right? Keep inflation down, keep jobs moving forward, keep GDP moving, and a little bit about trade probably still on the back half of some of the disruption last year. But what surprised you the most now, as we kind of get through the first half of the year that didn't play out perhaps like people were expecting?
Honestly, resilience. And probably shame on me because I feel like for the last 15, 16 years, the US consumer just continues to be resilient. But this time you also had business resiliency. So I would say that's the biggest one, despite all those shocks that you talked about. Yeah, resiliency really stands out.
And so, if you're looking, I guess, for the second half of the year, do you have another word that maybe you would pick for the economic conditions that you kind of expect through the rest of 26 and
Well, the
27?
phrase we keep using, slow down, not breakdown. And, I think that that's good characterization of the economy. And there I would focus on the labor market. We've been in this low fire, slow hire environment, we've been calling it. And I feel like, just that resiliency is really playing out in the labor market. And I think that the market's learning to live with this environment that we're in. So it's still constructive, even though we're saying slow down, slower growth, but still hanging tough.
So one of the hot topics has been geopolitical tensions because that tends to feel very uncertain for people. So talk a little bit about how the energy prices are affecting the economic outlook and how it's shaping the narrative for the back half of the year.
Yeah, that's exactly right. And that's something we spend a lot of time on focusing, where they connect. And the transmission channel we talk about all the time is inflation expectations. And we're constantly reminding investors that, oil prices don't just move on actual shortages or actual supply. It's the anticipation of what's going to
Right.
take hold. And same's true with inflation. It's not what is it doing today, it's what consumers, businesses think it's going to look like down the road. And that can really shape spending habits. And then that ties into the Fed and everything that they're going to have to do with interest rates. So that's the big one that we're looking at. And at least right now, inflation expectations really haven't de-anchored or drifted much higher, which is encouraging.
So the or I should say the consumer experience around inflation, we talk about the data points, but it really is what are they experiencing out in the real world, at the grocery store and at the gas pumps and things like that, because that's how consumers react to that information. And so from the inflation perspective, we've been talking about the higher for longer. So what does that mean? Can you just describe to our clients to our audience, what we're talking about there?
Yeah, so it has implications in fixed income, then portfolios, and what you want to do within bonds. But generally speaking, inflation is proving stickier. And I think we're also learning that the economy can continue to grow with a higher interest rate. And so when we say higher for longer, it's really the Fed being in this difficult position of can they take interest rates lower? Probably not right now because of where inflation's at. So when we look out, we feel like the market probably has it right. And what that means is investors probably have to become more comfortable with higher interest rates than they were used to over the last decade on kind of a go forward basis.
Yeah, and I think it's a great point about the last decade that you added on there because we do kind of forget a little bit because we had this 10-year stretch of almost no interest rates, super low inflation. But really, the numbers we're seeing today are kind of like historical averages, right? Over a 100-year span. And you're like, so they're not like unhealthy interest rates and or inflation numbers. I think inflation is actually below the 100-year rolling average right now for the last 2 years. So it feels high, but in reality, as we compare it to backward-looking things, it's not actually that bad, right? It's bad in comparison to maybe what we had 5 years ago, But in the grand scheme of the picture, I don't know that it's a concern moment on either one of those.
Yeah, I agree with that. And I feel like, maybe a little bit of overreaction, but we've been talking a lot about how the economy is normalizing.
Yeah.
And what I'll tie in there, Jamie, is it's normalizing from an abnormal period.
Mhm.
Yeah.
So that process is going to feel anything but normal. And I think that's what's going on right now is you're looking at, what drove the markets, what was that experience kind of the previous decade. That's not going to dictate what we look like going forward. So just becoming more comfortable with kind of adapting into
Mhm.
this environment. Yeah.
Yeah, and I think one thing every time we do this, though, I always have to like pause, like, but the cost of goods really did go up, right? We did see that spike. It's impacting a lot of Americans that are more paycheck to paycheck on the lower side of that K curve are feeling it. But at the same time, we're seeing growth and job growth and all these things, that are kind of balancing it. And I'm going to diverge for a second because I thought this was a really funny little bit I saw on a comedy show thing on like Instagram Reels or one of those. And the guy was like, what I learned was like, the economy is in trouble when oil is $120 a barrel. And he goes, I feel like that's a really good deal. If I went on Facebook Marketplace and just tried to buy a barrel, not full of anything, I feel like $100 would be a pretty good deal on Facebook Marketplace. And he's like, and people are all upset that you have magic black goo that makes cars drive for $100. And he's like, this feels like a really good deal. And I thought it was a very funny kind of take on it. But it does have a big impact on the world. But, even that, I feel like we've held oil prices, when you look at inflation, like fairly steady for a long period of time. We get those shocks on
Hmm.
anticipation. But, I think if you go back 20 years ago, people were probably expecting oil barrels today to be $250 a barrel. And the production kind of met this expectation and kept it low for the world for probably a longer extended time period than most people predicted.
Yeah, I agree with that. I mean, it's known, right? And we talk about it behaviorally. People tend to overestimate the near term, underestimate the long term. So, we adapt, we change, and we grow into it, and the world evolves. But yeah, I mean, rightfully so. Consumers focused on the higher interest rates, the higher oil prices because of everything going on in the Middle East. But yeah, we're seeing some stabilization. I think the bigger thing, like you said, taking a step back,
Yeah.
the bigger issues that we're focused on is more around like productivity. What does growth look like? I mean, those are the speed limits of the economy, less so kind of this noise I would describe it around the geopolitical stuff.
Yeah.
Mhm. So talk a little bit about what the Fed is balancing right now. They have a dual mandate, so give us a little bit of color on that.
Yeah, so it's a tough position. I think their dual mandate is they want full employment on the one hand and they price stability on the other hand. Right now, they're saying, we're a little less worried about the labor market because it has proven to be pretty stable. I mean, the unemployment rate is about where we were last year, so it's held pretty stable, which is one thing we nailed last time I was
Mhm.
on the show. So
Yeah.
happy about that. But on the other hand is the price stability and inflation, kind of this period of higher than target inflation continues to go on. And that's the real risk. Could that become embedded? How sustainable is kind of this runaway inflation? And so what we think that they're really focused on right now is the inflation expectations portion of it. And they want to make sure that those are anchored because if people expect higher inflation, they're going to pull
Right.
forward purchases, that whole notion. And look, I mean, they're in a difficult spot because they can get inflation back down to target by really aggressively hiking rates, but that comes with a cost.
Right.
That's going to hurt the economy. So we think that they're right for being patient, kind of on hold right now, understanding the risks, because there's always risk both ways. But yeah, that's the balancing act that they're going through.
So I want to dive into the labor market a little bit. You talked about this earlier. And what I find really interesting is that of the prime wage earners
Mhm.
from 25 to 55, it is
Hmm.
near like all-time highs in terms of employment numbers.
Hmm.
And what we've talked about is the labor market cooling, not cracking. So give us a little bit of insight into that.
Yeah, that's the key stat that we keep focusing on, those prime age workers, and we look at the employment to population ratio because there's a lot of churn in the labor market. And the difference between, we keep bringing up the past decade, but what you had back then, you had the baby boomers not retiring and the millennials graduating into the workforce. So that was like a really strong drip. Plus, you add on immigration, you get labor force looking a lot better in that environment. Flash forward to today, kind of deportation, immigration's down at zero or even negative, and then you have the baby boomers retiring. So it's kind of understanding the supply demand of that. Um, but the encouraging thing is exactly what you hit on, Kate, which is that the prime age, the prime earners, the prime spenders in the economy, they're holding its peak.
Mhm.
So that's why this low fire, slow, higher environment back to like
Yeah.
we're normalizing from an abnormal period. So it feels weird. Um, but the economy has kind of proven that it can still grow in this environment. And like we said, the unemployment rate really hasn't drifted higher.
And the truth is if we're getting paid, if the people in the prime wage earner age group are getting paid, we're spending money. So it goes back to what you said in the beginning of the show: is the consumer being resilient because we're supporting the economy by spending.
Yeah, and then, we still think like the top end of the distribution's driving some of the spending, so the wealth effects are real. House prices, I know appreciation on house prices has come down and we're closer to flat, which is probably what the Fed wants. Like you can't solve that problem
Yeah.
overnight. You could, but it would be painful. You'd rather like
Yeah.
grow into that. So I think you're spot on. Yeah.
Yeah, I think the housing one's tough because you've got the, Congress working on affordable housing type bills right now because that's a
Mhm.
concern is that more, what we always hear, like the starter home world seems to be struggling. Like you just
Hmm.
don't see
Yeah.
very many. The costs to build them aren't as efficient as to build a larger home. So we just get large homes built everywhere, which is this affordability challenge. But if that keeps running up, it's a bit of an issue. I was reading though that it does look like probably maybe not next year, but at some point we're going to start seeing this like back influx of housing from baby boomers as they start to age up a bit more because that is such a large generation in comparison to what's coming behind it now because I think the births are at 1.5 or 1.6 now, so we're like below replacement ratio now on births in the
Hmm.
US, and I think they project that 2030 will be like the first time we have a decrease in population in the US, which has really never happened here, right? Like we've never really seen that. Immigration could flip again by 2030 and maybe like hold that off. But I think last month was of like a 10-year low in immigration in the US and our birth rates continue to decline every year. So we are now entering this trajectory where the population growth, if immigration stays the same, might flatten. And so I think that brings us to the next one is if our working population starts to stall out, I think this is where AI starts to dominate the conversation and not just is it coming but like are we going to need it for productivity and efficiency with a labor market that might start to decline over the next 10 to 20 years.
Yeah, I think, productivity, we talk about and kind of label it this like magical elixir. And the reason is you can get stronger wage growth without as strong of inflation. You can get stronger economic growth. So it's like the speed limit of how fast an economy can grow. And, with housing and affordability, you're not going to solve these problems overnight. But if productivity can be strong, that can allow people to grow into it. And I think some of that is spot on with like, we've had a kink in the hose as far as like trading up and then
Yeah.
trading down. That's kind of gone away as people have been locked into mortgages, this and that. So maybe some of that unlock will happen over time.
Are we really seeing any productivity gains out there yet from AI or technology like or are we just seeing expenses ramp up for companies right now as they try to figure this out?
Yeah, the tokenization problem. No, well, it's productivity is a really hard thing to measure in real time. So it's really like only after the fact in history can you look at it. And in fact, the new Fed chair has been talking about this exact issue. He created a task force to kind of try to wrap his hands around it, wrap their hands around what's happening with productivity. And to answer your question, we've been seeing in the data stronger than kind of the last 10-year average was a little below 1% year over year growth
Yeah.
in productivity. So we're seeing above kind of 2%, but the data is noisy. So, I don't think we definitely don't want to overestimate that AI's solved everything and it's going to create this magical productivity boom. But at the same time, starting to see it in the data, if that continues, it's very encouraging. So it's something that we're really trying to look at. But even there, you really want to try to separate as best as you can
Mhm.
noise from signal and figure out where it's headed.
Yeah, I would definitely say, my like personal one is I don't know that I see it yet. And I have this like different litmus test about my life is I just keep asking myself every day when I walk around, when I live my day, like, am I seeing my day change due to AI yet? And the weird thing is, the answer is no, right? Like, I
Mhm.
got up, drove here, called somebody, right? Like, sent some emails. Maybe you used AI for the emails, and it's like, okay, so we have more emails from people. Great. And then, like, ordered a coffee, got food. I don't think AI touched any of these things yet today. Maybe somewhere on the back end, but, like, didn't notice it, right, in the
Right.
impact of my life, and so I keep trying to, like, just see when or where are we gonna notice the actual impact of on our lives. Probably the biggest advancement is if you drive a self-driving car, right,
Mhm.
that is having a meaningful impact, but outside that, I just am not seeing the change in daily life yet, and I think that's a big litmus test for anything, like, is it
Right.
changing the world? Do you notice it?
Mhm.
And I think maybe when we start to notice it, we'll start to feel like, hey, this is really showing up, and it's just a bit of kind of how I look at it, because I think that's the difference from like potential and real. Like, I think right now AI has all this potential, but when do we actually notice it in the way we live our lives? I think is something that eventually the markets are going to want to. So, what are you seeing on the market side as AI chips? That's been a dominant factor the last
Mhm.
year now. What do you think the markets are going to start looking for, and investors, as they look at AI and chips and potential turning into real? Like, what should we be watching for?
Yeah, the framework we use is it's kind of the evolution. At the beginning, it's all on the promise of what it
Yeah.
could,
Mhm.
valuation maybe expanding, earnings growth. I think we're graduating from the promise phase into kind of show me the proof, like
Yeah.
you're talking about. And so I do think that it's important for investors, and we've been trying to focus on like balance sheet fundamentals, looking for solid businesses, because we want to be more selective in this environment. There's pockets of the market. The encouraging thing is the market overall is being driven by earnings,
Mhm.
certainly over the last 6 months, 12 months. But even there, that's an aggregate, and I feel like that smooths out. There are some areas that are becoming stretched, like,
Yeah.
and you mentioned it's really around these areas that are kind of supply constrained, like the chips and that. So we want to be selective in the environment. I feel like the market's focusing on the show me phase.
So let's take that into portfolios. Equity markets have been very resilient. Can you talk about what is supporting that strength and then how we translate that for clients?
Yeah, well, I think it's earnings, back to earnings. Earnings growth has been really solid, and that's what's been driving the market. The market can go up two ways. It's either beauty contest or actual
Mhm.
fundamentals. So we're not seeing the beauty contest of like valuation expansion quite as much. Certain areas, yes, but overall, it's really earnings following through. And that's why we've been saying, the bigger risk probably right now to us is less the economic risk, more the expectation risk.
Mhm.
Because the market, we've been talking to investors about the market operates on better or worse, not good or
Right.
bad. And so earnings growth can still be really solid, still be really good, but if it ends up being, a little wobbly or a little less than that perfect scenario,
Yeah.
you could see
Mhm.
volatility around that.
I like that you hammer home that point frequently, better or worse, not good or bad, because investors react to that, clients react to that. And it is reframing it. So they're like, that's right. We did have double digit returns. It is a good thing. It just wasn't what was expected.
Yeah, and I think kind of back to that normalization period, it feels abnormal,
Hmm.
like the world's uncertain, there's volatility. It's kind of the price of the game, but yeah, you take a step back, we've had a great market for portfolios, great returns, and we're seeing opportunities still even as pessimistic as some of the headlines may be.
Well, we also, you talked a little bit about, just where interest rates are and yield. So, what should our, people that are listening out there, anyone be thinking about when it comes to fixed income today? Is it shifted from your views a year ago, or, yeah, what's the opportunity in that space today?
I mean, I think fixed income's one of the more exciting asset classes for a while. Like it's more in vogue for the first time in a long time. Just given that you can get, 4%, greater than 4% yield in something that's pretty stable. And even with inflation kind of proving stickier, 4% is still a little higher than that. And if inflation comes down, you're getting a real return. So it's offering an attractive complement to the portfolio. And we still think it offers diversification
Yeah.
benefit. Like at the end of the day, having that stability behaviorally, looking at, okay, this is going to fund my cash flows near term, that's important for investors.
Hmm. And we typically tend to focus on or anchor a little bit more to negative headlines. That just happens to be true, I think, in human behavior. When we see that, and you said it earlier, we react short term and underreact for long term possibilities. So, where do you think investors are most out of sync right now in their thinking or behavior?
Um, I think that they're most out of sync with really this view of interest rates being high for longer is going to kill the market.
Hmm.
And in aggregate, like Nobel Prize was won on the power of aggregates. Like a single forecast, my own forecast, is going to be less accurate than when we gather people together and they're all bringing new information. So the market's that on steroids. It's all every investor kind of bringing their own forecast, and it's a powerful thing. Now it can be dislocated from the future at times, but what the market's telling you right now is interest rates haven't come down and earnings are still growing. So I feel like certain segments of the market are maybe, you know, dislocated from what will happen, borrowing costs, et cetera. But overall, the market's kind of proven, again, back to that word, more resilient, and it can continue to grow in this high rate environment.
Yeah, and I think what you're seeing when you look at some other areas too, when we look at some of the commercial clients here, they have cash on hand. They
Hmm.
don't feel like even borrowing at the rates today are prohibitive based off of where they think they can grow into things. So you're not seeing that slowdown in loans out there. Like I actually think expectations, I think Piper Sandler said expectations the next quarter is like really high on borrowing. Like they expect to see companies doing it and actually just taking advantage. And so you look at those things, you've got good cash on hand, people are still borrowing, people are still investing in building. That's kind of telling you that it's not maybe a hurdle where companies feel like they can grow based off of where the borrowing rate is. So, because that's a bit of the measure, right? It's not just is it high, but is it higher than, my return would be if I'm going to borrow? And if the answer is no, you still do it.
Right.
Right.
Yeah, and we're seeing that in the data. My favorite thing coming on the data right now, mainly excited from like an animal spirits
Yeah.
perspective, is new business formation,
Mhm.
according to the IRS, is higher today than it was in 2020 when interest rates were free, venture
Yeah.
capital was like
Right.
spray and
Everywhere.
pray, any
Right.
idea was worth funding. Now, like you said, Jamie, interest rates are higher and people are still forming new business.
Yeah.
So
Right.
they see the opportunity set. Maybe that's where AI is partially helping kind of erode like startup costs in that. But that's good overall for the economy.
Yeah, I think so too. And I think two things that when we're talking to clients today and anybody listening, there has been a massive run up in the equities. I mean, lots of returns for people. We've seen the number of 401k millionaires grow, and that's been really positive. I will say though, I am running into people that at this point, they're probably funded for retirement. And the question is like, should they de-risk their portfolio a bit? If their goal is really, I want to be safe for the next 20 years or next 10 years, I think that answer when you talk about fixed income and
Mm.
4% kind of returns in that market you can lock in today is appealing. I think some people probably should rebalance their portfolio right now, but it's kind of based off your goals.
Right.
But I think if you're right at that time period where you probably are funded for retirement and can de-risk, I think that's appealing to a lot of people. But what else are you seeing from a practical standpoint of like what investors and clients should be doing today? Like what's something that you actually feel like is actionable?
Well, the answer is probably less than people expect.
Yeah.
Like reacting to the headlines, you just end up chasing your
Mhm.
tail. Back to that better or worse framework, like the market's pretty efficient. If it's not fully efficient, it's pretty efficient. It reflects new information almost immediately. So when we're talking to clients, by the time you're reading the headline news, the
Yeah.
market's absorbed that thinking
Right.
12 months forward. And so, yeah, I mean, probably a good plug to not let like the headlines and investment decisions really cause you to just want to turn over your portfolio. Really starting with the goal, like you said,
Right.
and working back from there.
Yeah.
Like, hey, we're in a better spot, so we don't need to be taking this risk. Or we're in a better spot, so we can carve out a piece of the
Yeah.
portfolio and take more risks. I think that's the more impactful, better outcome decisions that can be made right now in this environment.
I think the planning piece is important, which is what I think you're talking about. Everybody's different. You could talk about percentages, but what is everybody's individual situation? And then how do we plan for that and use the investments as the tool to reach that goal?
100%. Tool in the toolkit to get
Right.
you to where you want to be from a planning perspective.
So we talked about normalization. We talked about cooling, not cracking. What is one thing that your team is watching closely now that might not be getting a lot of attention?
It's got to be productivity. If I could have a crystal ball of one data metric for what it ends up doing over the next 10 years, I would want to know productivity. It drives everything. It can, I mean, like all the affordability issues that we're talking about, how fast the economy can grow, wage growth. Productivity is really the big one for us, and it's hard to measure in real time. So we're focused on each of these data points, whether it's bottoms up from companies' earnings, top down from the economic data. We really want to see how this evolves, and then what does that mean for inflation expectations? What does that mean for the Fed? What does that mean for potential growth in earnings? When you buy a stock, you're buying it for those future earnings. So yeah, productivity would be the big one for us.
Can you simply translate how that affects portfolios in the back half of the year?
Yeah. So, I mean, I think that the biggest kind of connection point is back to the Fed. Because if we have stronger productivity, then that insulates some of these costs. Costs can go up, but we're producing more. Historically, the healthiest way an economy grows is when productivity growth is faster than wage growth.
Mhm.
Faster than unit labor costs is the economic term. So when that's happening, companies can grow their margins, and they can still generate earnings, and that would really allow positive opportunities for the market. Now, the big thing is back to that expectation risk around how much is already priced in, what are the expectations on earnings, and do we need to discount that a little bit with borrowing costs being higher than maybe the market forecasted coming into the year. But yeah, we still think it's an opportunistic market, maybe just a little cautious on where you want to be and being a little more selective.
Love that. Well, let's go to our rapid fire round to wrap up here today. But soft landing or something bumpier ahead. First thing that comes to mind.
Soft landing, but it won't be smooth. Cheater's answer.
That was yeah. That's like the pilot who still lands the plane, and you're like, we did land,
Yeah.
but
Maybe not grabbing, the sick bags or whatever,
yeah,
but you're on the tarmac.
yeah.
Yeah.
Oh, that's funny. Okay, so next Fed move: cut, hold, or hike?
Hold.
Biggest risks investors are underestimating.
I would say sticky inflation,
Okay.
Okay. One asset class that you'd lean into right now.
quality fixed income.
Okay. What's one the hot take? What's one market consensus? You talk about how good the
Mhm.
aggregate is, but go against one. Which one do you think that everybody's getting wrong today?
Well, I guess AI comes to mind, and a longer winded answer would be this dystopian view of AI in the labor market.
Yeah.
And I'm always reminded of this conversation I had with a career mentor during like a bear market, couple of maybe 5-10 years ago, about animal spirits. And he said, look, someone somewhere is in a garage maybe inventing the next technology that propels the economy. And the big thing right now economically is this term that comes to mind, Jevons paradox. And it was around the industrial revolution. The cost of coal, the efficiency of coal was coming down, but they noticed more coal was being consumed. So what does that mean today? You look at like travel agents. Internet and AI on steroids has reduced that cost, but yet we have more travel agents today than we did decades ago. So to me, like that dystopian view on the labor market, I feel like AI is not going to erode opportunities. They're going to
Yeah.
evolve, and then we'll adapt as humans, and there'll be, successes that come out of it.
Yeah, that one was not a lightning answer, but I appreciate it. It's a good one. One more though for you, talking about potential underperformance, and we got to call you out on this one. But the Eagles or the Lions this year, who's more likely to make it through the
I
NFC?
was looking the other day. Vegas has the Lions doing better, so I'll
Yeah.
stick
All
with
right.
the
You're gonna stick
Lions.
with the
Although
Lions.
every year I drink the Honolulu Blue Kool Aid, and then I'm heartbroken.
Yeah, yeah, that's it. It's tough, you know. My Washington Commanders really. It was an enjoyable win 2 years ago against the
Yeah, it
Lions.
still
So
hurts.
yeah, we've got a mix here of Phillies
That's
and
funny.
NFC fan base on this show today. But now I think my money would be on the Eagles. I think they're going to have a solid year, for all of our listeners. I'm
Mhm.
going with the Eagles
Okay.
on this one.
That's fine with me.
Kate,
Clients are happier when the
yeah,
Eagles do better.
Kate, do you have any opinion on this one at all today?
So here's what I will say is that the Eagles won the Super Bowl in 2018 on my birthday. And I've been
Okay.
a
Oh,
lifelong Eagles fan. And then I just kind of hung on to that Super Bowl win and let it go. So I watch it a little bit more for entertainment now. I'm
Yeah.
not as closely tied to it, but
I
still
wish I knew
enjoy
that
it.
feeling. Maybe one
Yeah.
day, but yeah,
Yeah,
not yet.
one day you will have that feeling.
Yeah.
It's but thank you, Andrew, for being on the show today, for all the insights out there on the market and for our clients and just the region too. I think a lot of people listen to this, get ideas. And if you are someone listening, you're saying, hey, I don't know where my portfolio is today, reach out to us. We'd be happy to talk through that and see, are your goals and how you're investing aligned today with everything going on out there. But yeah, really appreciate you for being on the show today and all the work you do, Andrew.
Yeah. Thanks, Jamie. Thanks,
Thanks,
Kate.
Andrew.
And Kate, thanks for sharing the Eagles and your birthday. It's super exciting. So we'll be cheering for another Eagles Super Bowl on your birthday
Yes,
this year.
please.
Although it's unlikely it falls on the same,
Unlikely.
yeah,
Yeah.
but it sometimes they fall on the same day. But everyone else, thank you for listening to this week's episode of the Planning Perspectives podcast. Make sure you subscribe on your favorite podcast channel so you never miss an episode.